Hi, everyone. This is Hunter Satterfield, a partner here at CWA, as well as one of the members of the investment committee. This is your December monthly market update. As always, I'm joined by one of my fellow partners, Brian Bortz, who is also head of our investment committee, and then the managing director of Tectonic Advisors, Brad Sanders. Thank you, gentlemen, for joining me as always. Now, as far as returns go, we're showing returns here both for December and also for 2020. The S&P 500 for December was up 3.8% with an annualized return for the year of 18.4%. Global stocks were up 5% in December and 16.3% for the year. Domestic bonds were up just over 0%, 0.1%, and annualized at 7.5%. And then finally, global bonds are up 1.3 with a total return for the year of 9.2. So obviously, if you've been following along with us with each of our monthly updates, we've had some tremendous swings this year in the market and seen some peaks and seen some valleys. And Brad, I kind of want to start with you, obviously, as we finish very strongly here in towards the end of the year. What are some of the things that you saw as we kind of headed into the end of the year that caused a lot of that strong finish? And then also, what are you sort of looking at ahead of 2021?
Yeah, I think piggybacking on last month, what really propelled the market through the end of the year was just getting the election out of the way, and then really the vaccine. I think was the main reason. It represents light at the end of the tunnel and a resumption of kind of some normalcy in the markets and in everyday life. It's just something all of us want, and so just kind of probably injected some optimism into the markets that had been lacking for the majority of 2020, and that's carried us through into the start of this year. Some things we're watching this year, we're cautiously optimistic about the year. Some things we're paying particular attention to at Tectonic are number one, we're watching valuations. If you just look at valuations without digging into them, you'll see that they look very elevated here, much the same as they did entering 2020. You know, the market was very expensive fundamentally. It looks even more so now, but part of the cause of that is that earnings estimates have been revised downwards so much post-lockdown that you have the stock market at all-time highs, and then the denominator of that PE ratio is artificially depressed. So what we would like to see is as people get vaccinated and as business activity starts to inch its way back towards normal or whatever the new normal is going to be, we'd like to see that earnings number reinflate and kind of catch up a little bit to the valuations they are. If it fails to do that, it's going to probably lead to kind of a rocky scenario. So that's something we're watching. We fully anticipate, though, through the first half of the year, comps are going to be relatively easy, and that earnings are going to be able to play catch up and kind of grow into that valuation where stocks are already trading. I think the market already knows this, but it is something that bears watching. Another thing that flipped in the fourth quarter of 2020 is that value for the first time in a long time outperformed growth by about 5% for the quarter. What we think is causing that are inflation expectations. Historically, technology and the technology sector does really well when there's low to no inflation. And that's what we've had over the past decade. And that's what's allowed FANG and a lot of these stocks to reach these valuations that have never been seen before in market history. Inflation expectations are different now. There is a view that inflation is going to pick up and is going to run hotter than it has, particularly over the past decade. That's a scenario where you could start to see other parts of the market become the new leadership. And that's certainly what the market started to shift to in the fourth quarter. That's certainly something that we would like to see as investors that look at fundamentals and invest in companies that have strong balance sheets and maybe a better earnings picture or better traditional metrics than some of these tech stocks do. That's something we're watching. And just in general, we're also watching on the bond side of the portfolio. We're also watching the credit side of the portfolio. We're light on credit here, but it's something that we bears watching. Interestingly, we're in a scenario now. The past 4 or 5 different credit problems we've had have all been really liquidity driven at its heart. The market just disappears and You have problems with the bond market and the credit market. We now have some solvency issues in some areas that have been stressed through 2020, and it's going to, potentially be an area where there's going to be some really good opportunities going forward. So that's something that we're watching as we move into 2021.
Yeah, that's helpful to kind of hear some of the things that we've seen and we're seeing. And Brian, I want to come over to you because I mean those numbers I shared earlier. I mean, for any of our clients that we're working with that have any sort of allocation to stocks with those double-digit returns and then bonds doing very well as well, we saw portfolios, most people's portfolios up double digits for the year, which is sort of crazy to think given the year that we went through. So what are the conversations you're having in particular with clients? And then also in light of what Brad's kind of talked about, what are the conversations you're having about, going forward into 2021?
Yeah, thanks, Hunter. To piggyback on what Brad just mentioned, we're coming off of two fairly strong market performing years in 19 and in 20. And we have an economy that is incredibly resilient right now. And given that, if you look at what some of the government action has been by creating an immense amount or an unprecedented amount of liquidity, that along with perhaps future expectations of even more liquidity being generated is really going to be fuel to an economic fire to some extent. And so, when Brad was talking about the price earnings ratio and how the market looks currently to be expensive, some of it due to perhaps a falsely low earnings number from last year. Think about what that means for this year. For this year, especially in the first half of the year, a lot of publicly traded companies are probably going to find it a little bit easier to beat earnings expectations, or at least compare year over year to beat last year. And in an economy where you have a strong economy, a strong market, a lot of liquidity, and you're beating last year's earnings, that's a recipe for growth. And so we're cautiously optimistic.
Yeah, so thanks guys for kind of the recap of a crazy year of 2020. And as always, we'll be back in front of you at the end of January with an update on the numbers from January. So thank you so much.